Hi guys, welcome to this episode of type of indicators. So today we'll be talking about the type of indicators which are most commonly used in the market lah. So I'll be only covering a few, the common ones only, which are most commonly used by people lah. Okay, so the first one will be a moving average convergence divergence (MECD). You will always hear this word MECD. So this indicator is actually formed using two moving averages, and is the moving average is calculated by adding the stock's price over a certain period of time and then dividing it over the total number of periods. Okay, so if let's say they say a 12-day moving average, it means it's average of prices over the past 12 days. Then after that they'll take it and divide by the number of days, which is 12 lah. Okay, so if you are using the app TradingView, if you're using the same software that I usually use, the moment you open TradingView, you just go into the indicator site, which I will show you shortly, and then you just click MACD, it will appear. The default setting of MACD there is actually 12 and 26. That means you will use a 12-day moving average and also a 26 days moving average. If you go into the settings, you will see, which I will also show it to you in a while. So in theory, for MACD, whenever the 12-day moving average crosses up on top of the 26-day moving average, it is considered as a buy signal. And when the 12-day moving average crosses down of the 26-day, is considered as a sell signal, means like it's kind of bearish lah. Okay, so now I will just go over to the TradingView and show you. So if you so this is TradingView app. So if you actually look at the indicator side, you just need to go and type MACD, and this will appear. Okay, you just click it and it will automatically appear at the bottom of the chart lah. Okay, so some of you may be wondering what's the, like there's a volume over here. It's actually the strength of the the movement lah. Okay, so if you go over to the settings of MACD, you see the input, the fast length is 12 and the slow length is 26. Okay, so that one will be the fast one, which is 12 days, and the other one will be 26 lah. Okay, which is the slow one. So we look at here. Okay, we just do a back test lah. Okay, for you to easy understand. So you don't know which is the fast and the slow one. So for you to just see, you just look at here, like the stock is going up, so definitely the blue one is the faster one lah. Okay, why you can say that is because the 12-day moving averages, the 12-day moving average will always be faster compared to the 26. 26 will be the slower one. Okay, because you need an average of 26 days for the 26 days moving average. Compared to the 12-day moving average, you only need 12 days of price. Okay, so the 12th one will always be the faster one. So you see, like, when the stock is going up over here, you can see that the blue line moves faster. Okay, technically, logical thinking lah. You can also use the settings there to see. So this one will actually move faster, and when it comes down like here, you see when it comes down, it affects this very fast, whereas this one is affected slower. Okay, so that is how you differentiate between the 12 and 26 days. So technically, they say, if let's say, if it crosses like this is like a dead cross lah. Okay, that means it's like a sell signal. Okay, using this indicator. Whereas when you have a crossing over something like this, okay, it's actually a buy signal lah. Okay, so that's how to use this indicator. Whatever indicator you use, most important, before you use it, open the chart and do a back test. So what do I mean by a back test? Okay, every time, if let's say MACD, the theory is that whenever the 12 goes above the 26, it crosses over, it's a buy signal. Okay, you need to test and see for every time that it has crossed over, that it has done a crossover between the 12 going on top of the 26, did the chart follow? Okay, because you need to remember the indicator is always slightly lagging behind the price action itself. Okay, it's always like behind it lah. Okay, the price must happen first, then only the indicator will show you. Okay, similar to here. Okay, you see here cross already, but then it's still nothing much, and then here it actually rose up quite a lot. Okay, and then only it came down over here. Okay, so you see over here, this is like, the time the indicator is telling you to sell, but actually it has already been read from here. Okay, so that's why they say the indicator lags behind compared to the price action lah. Okay, so price action is actually the fastest one and most important one. Okay, so now we'll move over to the next indicator. So the next indicator will be relative strength index, which is RSI. More commonly, you will know it as, you know, when someone say it's oversold or overbought. You know, this is the most often indicator that they use lah. Okay, relative strength index. So what relative strength index says is that the stock will usually hover around the range of 30 to 70. Okay, when it hits 30 at the bottom over here. Okay, this 30 indicates that the stock is oversold, whereas when it hits the top, it indicates that it's overbought. Okay, so when it's oversold, it means that there's a possibility of a rebound going to happen, and when it's overbought, there's a possibility that it's going to come down. Okay, so I think it will be better explained using a chart. We will move over to the chart to have a look what it means lah. Okay, so moving over to, we will just use the same chart. I'm going to remove the MACD and indicator. We just type RSI, it will come out relative strength index. You click once and it will appear. Okay, so what this is trying to say is that okay, we just take an example from, okay, we take from here lah. Okay, so what it's trying to say is that this is the 70 line, and when it reaches here, there's a possibility that it will come down because it's like kind of overbought lah. Okay, like from here. Okay, then you see here, let's zoom in a bit. Okay, you see like here, you know, it has reached a peak of about 87, so it's like relatively overbought quite a lot, so it came back down. Okay, it comes back down, then it starts climbing higher again, and then here it's a bit overbought again, then it comes down all the way until here, and then it starts to rebound over here, and it continues climbing higher and higher. Okay, so like I say, the most important thing whenever you use any indicator is to backtest. You need to see whether whatever that you have seen, is the indicator actually working or not for the stock. Okay, so like for example here, it's like at the center line and then it went up much higher. Okay, then this is considered overbought territory, and then it comes down, so kind of correct lah. Okay, but what you need to remember is stocks are able to stay in an overbought or oversold position for quite some time. Okay, so for example, we see here, okay, it came up to overbought level on 25th of January, but it continued going higher, and it only started reversing from this overbought territory of 93, like quite about 1 or 2 weeks after the indicator show that it's overbought. Okay, so an overbought stock can stay overbought for quite some time. Same goes with oversold lah. Okay, it can stay oversold for quite some time. Okay, for example here, if you look at this indicator, it's actually already like showing you, wait here it's already showing you that it's already hitting the oversold position. Okay, but then it continues staying oversold until about here only it came back up. Okay, so that's about RSI. You need to know, you need to remember that the stock can stay overbought or oversold for quite some time. Okay, now we go back to the slides. We have a look at another common indicator. Okay, so the next indicator will be Bollinger Bands. This one also I think quite regularly used. It's actually they plot it using two moving averages. But this standard deviation, I'm not so sure how it works lah. Okay, but it's used using two simple moving averages. And the theory is that the stock price is supposed to move between this band. Okay, there's an upper band and lower band. It's actually two moving averages, and the stock is supposed to move in between them lah. Okay, so now we move over to the chart and see. Okay, looking at the chart, okay, let's remove RSI first. Then we add Bollinger Band. Just type BB. Okay, it's quite well known already, Bollinger Band. Okay, so this is Bollinger Band basically. Let me hide the others first. Okay, Bollinger Band is actually produced from two moving averages. Okay, the 20 is actually the range lah. Okay, so what Bollinger Band says is whatever happens to the stock, it will always stay within this band. Okay, and if let's say it goes out you know, sometimes stock they have parabolic effect, they tend to actually go out, it will eventually come back into this band. Okay, so you can have a look here, you know, it flew up over here, you know, came up, then came back down, and then went up. This is parabolic already lah. Okay, it went parabolic means is the movement is a bit too steep. Okay, you see like here, this is the line. Okay, but when you have a parabolic effect, you tend to go out. Okay, this is totally out. Okay, so it will take some time to pull back and enter back into the band. Okay, so it comes up over here, and then, you know, once it hits, it's supposed, technically what Bollinger Band says is when it hits the upper band or the lower band, it's supposed to rebound and stay inside that band. Okay, that's the theory behind Bollinger Band now. Okay, so it hits, then comes back down, you know, then hovers around here, and then when there's this breakout, okay, you can see that it's kind of staying on the upper band now. Okay, came back down, come back inside, went through, tested the upper band again, failed, then come back down again. Okay, so then you can continue, you can see lah. Okay, it kind of respects the upper and lower band lah. Okay, here, okay, comes up here, hover again, okay, hit the top, then come back down again. Okay, so that is how Bollinger Band works. Okay, now we move to the last indicator that I'll be talking, which is moving averages. So moving on to moving average, it's actually quite similar to what you have seen in the previous indicator, which is MACD, because MACD is actually made from using two moving averages. Okay, the 12 and 26 one. So this one, the moving average, which is the most commonly used one, I'll be talking about the 50 days, 150 days, and also the 200 days moving average, which is also 50 days is the 10-week moving average, 150 is 30 weeks, and 200 days is the 40 weeks moving average. Okay, so let's go over to the TradingView app and have a look. Okay, now coming back to the chart. Let's remove Bollinger Band first. I already have moving averages, so I usually have 3 moving averages, which are the most common ones lah. Okay, which is the 50 day, 150 days, and the 200 days. So on theory, 50 days is supposed to be a shorter one, shorter term. 150 is mid term, and 200 days is the long term moving average lah. Okay, on theory only. Okay, so it is said that price actions will actually respect the moving averages lah. Okay, so if you have a look at this, what happened here is we look at PMB Tech before it started the very aggressive breakout. So you can see that it went up, okay, hover around the 50 days moving average, and then it broke out, you know, at this about here lah. Okay, you can see actually this is like a rounding bottom. Okay, it came up to here, then broke out. So once it broke out, it ran up high quite aggressively, and subsequently it came back about here and consolidated. Okay, back then I think PMB Tech is not so cheap. I think this one was about more than 10 bucks lah. Okay, as I remember, but I can't remember the split was how many. Okay, so the moving average says that the stock will always come back and respect the 50 days moving average line. Okay, for short term. Not really short term lah, like maybe a month or two kind of thing. Okay, so what has happened to the stock is that it actually went up, then came back down, and it was basing around here lah. Okay, it was a long consolidation. Okay, from like here all the way until here lah. Okay, so if you see, it's like what, November 2021 until January 2022, which is about about 3 months lah. Okay, so then after a long consolidation, okay, consolidation needs very low volume. That means it's a very quiet base. That is like one of the requirements for kind of like a super stock lah. Okay, it means like it can rally very well. Okay, I will show you another chart later. So it was hovering around the 50 days, and then it shot up. Okay, shot up already, then it came back down. Okay, so it's kind of like every time it shoots up, you know, it can rally a lot, but it will still come back down and respect the 50 days moving average. Okay, so the definition of a stock that is being bullish is when the stock's price is above all its moving averages, which is the 50, 150, and also 200. Okay, because as I told you before, moving average, all these indicators are lagging behind the price action. Okay, so when you have a movement like this, the price action will move first, then only the moving averages will follow. Okay, so moving averages will always be lagging behind. With that, when your price actually moves faster, it naturally means your moving average will be lagging behind. Okay, so for example, at this place, it has shot up quite a lot, but you see the moving average of 50 days. Okay, you just look at this area. Okay, it actually shot up here, but the moving average was still kind of flat until here. Okay, until here only it started changing the direction lah. Okay, so that is what I mean by it's a bit slower. Okay, and that is the 50 days. Okay, the 150 and 200 one were actually not really affected. It was more of a trend change here. The reason why is because the bar is a lot. Okay, it's like 37 bits, so a huge price action will cause the 150 and 200 days to actually change also lah. Okay, so if you compare the 150 and 200 one, actually you can see the 51 is bent, the angle is bent much steeper, okay, compared to the 150 and 200 one. Okay, so on theory, it will always respect back the 50 days moving average, and when it breaks down, it's considered as bearish. Okay, so how do you use 50 and 50, 150 and 200? Just remember, the 50 days moving average will be the first moving average to respect. Okay, upon breaking that, stocks will respect the next one, which is the 150, and anything happens to 150, then it will respect the 200 one. The 200 is considered as the last line of defense lah. Okay, if let's say the stock is not doing well, in the long term, they tend to break the 200 days moving average. Okay, but if let's say the stock has a good long term, they tend to be supported by the 200 days moving average. Okay, so that is the thing that you need to bear in mind lah. Okay, so for this stock, you can see that it came down, it broke down, okay, and then it came back up, and it's still respecting the 50 days moving average. Until recently, I think it is already below the 50, 200 and also 150 days moving average. Means this stock is quite bearish lah. Okay, if you look at it, this is a bit out of the moving average topic. If you look at it, you can actually see it's kind of like a head and shoulders here lah. Okay, which I won't go deep into now, maybe for another episode lah. Okay, so the other stock that has a very nice base is actually Wells. Okay, if we do a case study on Wells, you can see that the volume, we just put the first day volume out because the first day is like, you know, IPO, everyone sell, buy, trade. Okay, so if you look at the basing from this area all the way until here, you know, the volume is exceptionally low. Okay, most of the days it's below the 10 days average of volume. Okay, and then when it break out, which is this candle and also this candle, the volume actually started coming in. So if you want to spot, you know, a very good movement stock, you have to find stocks which have long bases like these lah. Okay, so but the moving average, but this is an IPO stock, it's a bit hard to use moving averages, because if let's say even if you want 50 days moving average, you need 50 days of trading days first. Okay, if not, there's no way for you to calculate a 50 days moving average, correct? So you need 50 days of trading first, then only the 50 days can come out. Okay, so this is a bit different lah compared to moving averages. Okay, so currently it's a bit below lah, the selling has already started, and you see the volume is much more erratic compared to previously. Okay, previously per day is like very little, here is like 3 million, 6 million, but nowadays the volume is like what, 4 million, 7 million, 8 million. Okay, it's much more active lah. Okay, basically this was when people accumulate, you know, people don't know, most people don't even know about Wells. Okay, this is stages lah. Okay, this is like stage 1 accumulation. Okay, then you have stage 2, you have stage 2 over here, which is the markup lah. Okay, this is when most people already know and they try to join in. They're like, oh, I'm late, you know, time to go in. And then this is stage 3, which is what we call the distribution, but this distribution is a bit aggressive. It's quite expected to be aggressive because the movement up was also aggressive and there was no waiting in between. Okay, the only basing only happened here. Okay, that was like quite a stop lah. Okay, and then stage 4 will take place lah. It will be quite low. After stage 4, usually stage 1 tends to come back lah. Okay, so that's for Wells. And that will be all for my topic of commonly used indicators. Maybe in the next episode, maybe we can talk about support and resistance. We will talk about something else lah. So I hope you enjoyed this video. I hope that it benefited you. If you are using the indicators, maybe it will give you a better idea on what the indicators mean and how to use them. Okay, that will be all. Thank you. Bye bye.
If you liked this video, be sure to hit the like button and subscribe for more videos.